right, so you're thinking about investing in Florida real estate. Smart move. But you've got to know you're playing a totally different financial game down here. Today, we're going to break down the exact tax rules and legal setups you absolutely need to understand, from the huge state-level perks to the critical federal warnings that could honestly save you a fortune. Let's dive in. Okay, but first, a really important heads up. Let's get this crystal clear. What we're about to go through is a roadmap to help you understand the landscape. It is not, and I repeat, not a substitute for getting real, personalized advice from a qualified CPA or an attorney. Everyone's situation is different, so use this explainer to learn how to ask the right questions, not to get your final answers. Deal?
So here's our game plan for today. We're going to kick things off with the big headline, the thing that gets everyone excited about Florida. Then we'll get down to earth with the reality of property taxes. After that, we'll open up the federal toolkit, some seriously powerful stuff in there. We'll talk about building your legal armor, and then we'll wrap up with some pro-level strategies and a few major warnings you can't afford to ignore.
All right, let's jump right into the good stuff. What's the #1 fiscal reason that sends investors flocking to Florida? It really all boils down to one incredibly powerful number. That's it, 0. We're not talking about a discount or some special promotion. That's Florida's actual state income tax rate for individuals. This one simple fact is the launchpad for every investor, giving you an immediate built-in financial edge before you even sign the closing papers.
And that 0%, it goes straight into your bank account. I mean, think about it. The rent checks you collect every month, the big profit you make when you finally sell, no state income tax. None. Now, if you're in a place like New York or California, that same $100,000 in rental income could mean a $10,000 tax bill to the state. Here, it's 0. That is a massive, massive head start.
Now, that state-level advantage is fantastic, no doubt about it. But it's only half the story. To really get the full picture, you have to zoom into the local level, where you'll see the tax reality for an investor is a whole different ballgame.
Which brings us to the other big tax that every single property owner has to deal with. See, while the state gives you this huge break on income, the local counties and cities, well, they still need to pay for things. And that's where property taxes come roaring in.
And this right here is a distinction every investor has to burn into their brain. All those great tax protections that Florida residents get on the house they live in, they do not apply to your investment properties, so there's no homestead exemption to knock down your taxable value. And, even more importantly, there's no Save Our Homes cap to limit how much your taxes can go up each year. What does that mean for you? It means a homeowner's tax bill is nice and predictable, but your investment property's tax can shoot straight up with the market. That's a volatility you have to plan for.
Okay, so that's the state and local scene. But the strategy doesn't end there, not by a long shot. Once we look at the federal level, a whole new toolkit opens up. And this is where savvy investors find some really powerful ways to slash their tax bill. And the biggest, most powerful tool in that kit is depreciation. Now, I know the word sounds bad, right? Like something is losing value. But in the tax universe, it's an amazing advantage. The IRS actually lets you deduct the supposed wear and tear on your building each year, even while that same building is probably going up in actual market value. It's a beautiful thing.
So what's this useful life we're talking about? Well, the IRS has basically set this magic number for any residential rental property, and that number is 27.5 years. This isn't just some boring accounting rule, it's a strategic timeline. It means for almost 3 decades, you get to deduct a slice of your property's cost right off your taxable income, year in, year out.
Let's just walk through how this actually works. Step 1, you collect your rent. That's real cash hitting your bank account. Step 2, on your tax return, you deduct all your real expenses, mortgage interest, repairs, all that, plus this magic non-cash expense called depreciation. And step 3, the result, you end up with a much lower taxable income, sometimes even a paper loss, which dramatically cuts the federal tax you owe on the real cash you made. It is the cornerstone of real estate tax strategy.
Okay, so making money is one thing, keeping it safe is another. And that brings us to the super important topic of legal structure. You can think of it as the legal armor you build around all your hard-earned assets.
For the vast majority of real estate investors, the journey starts and ends right here, with the LLC. Its #1 job, asset protection. It basically builds a legal wall between your personal stuff, your home, your savings, your car, and your business. So if heaven forbid a lawsuit pops up related to the property, it can only go after the LLC's assets, not your personal wealth. And for taxes, it's usually just a pass-through, which means the profits and losses just flow right onto your personal tax return. Simple and effective. So when would you ever think about something more complex, like an S-Corp? Well, both give you great protection. But the S-Corp is a real next-level play. For investors with bigger operations, it can potentially save you a good chunk on self-employment taxes. But, and this is a huge but, it brings a ton more complexity. We're talking running payroll, holding formal meetings, keeping detailed minutes, the whole shebang. This is one of those decisions where you absolutely have to sit down with a tax pro and run the numbers.
All right, let's get into the advanced playbook. We're going to look at a powerful but often misunderstood federal program. And then we have to cover a critical warning that every single foreign investor absolutely needs to hear.
So you've probably heard the buzzword opportunity zones. This is a federal program that's designed to give people to invest long-term in certain economically challenged areas by offering some seriously sweet tax breaks, especially on capital gains.
But here's the secret sauce that people miss. The tax label itself isn't what makes it a good investment. Let's take Lehigh Acres over in Southwest Florida. Yup, it's an opportunity zone. But the real story is the 26% population boom. And why is that happening? Because folks are getting priced out of nearby Naples, where homes are 600 grand, and they're flocking to Lehigh for homes under 250,000. That's the real opportunity.
So the lesson here is pretty simple. The tax break is the cherry on top. It's not the whole sundae. Real success comes from digging in and analyzing the fundamentals on the ground. The demographics, the affordability, the direction things are growing. You're investing in a community's future, not just in a tax loophole.
And now for a massive warning. And this is aimed squarely at foreign investors. I want you to look at this number and remember it, 15%. Now listen closely. This is not a tax on your profit. This is a mandatory withholding on the entire gross selling price of a property when it's sold by a non-U.S. person.
This rule is called FIRPTA. At the closing table, the buyer is legally forced to hold back 15% of the total price and mail it straight to the IRS. So on a $500,000 sale, that's 75 grand that you, the seller, just don't get. Now, you might be able to get some of it back later by filing a tax return, but it's a huge cash flow trap if you're not ready for it. This is something you have to plan for with your experts from the day you even think about buying.
Whew, okay, let's do a quick recap of the biggest takeaways. Number 1, Florida's 0% state income tax is a massive head start. 2, property taxes on your rentals are volatile, so budget accordingly. 3, on the federal side, depreciation is your best friend. 4, an LLC is your must-have legal armor. And 5, if you are a foreign investor, you must have a plan for FIRPTA, period.
And that brings us to one final thought. We've gone over the rules of the game today. But the truly great opportunities are always born from the changes happening tomorrow. So the question I want to leave you with is this. What changes in technology and population shifts in new infrastructure are quietly creating the next Lehigh Acres, the next big opportunity? Finding the answer to that, well, that's the real art of investing. Thanks for joining us on The Explainer.